Hello again. Welcome back to the strategy course. What we're going to be discussing now is business models. And business models, the important thing about them to understand is they help us go and analyze not only value creation, but also value capture. Of course, before that, we need to go back to what is the story of value creation and capture and how do we measure this. I'm going to be taking some of ideas from accounting and finance to go deeper into it. So for now, back to if you want a refresher on value creation and capture. What is this? Value creation, what the company creates for customers. You produce something, you give it to them, they buy it, and then they are going to be happy with it. Some concepts that are important here, customer willingness to pay, how customers think that this particular product or service is going to, with all the features and all the social and the emotional dimensions, is going to create value for them. The price they pay is going to be the difference. That difference with the price is going to be the value that they are going to be capturing from it. The challenge here is that in many cases, we don't know how much they are willing to pay for the product. We don't know how much value they are capturing, how much value we are creating. All we know is that, well, if we price at this point, all of a sudden we have people buying it. That's nice. Now the next question is, okay, so on top of that, from all the different people who contribute to the company, of course, we have to compensate for their effort for what they have done to create that product or service. So we're going to be facing costs. Those are basically the contributions that others have had to that value creation. So we are going to pay that. And there, the question is, are we going to have a difference between the price and the cost? If we're able to cover the cost, so yes, it's not only that the company is providing value to customers and going to capture some of it, but it's going to be something that keeps the company keeps. Otherwise, it might just go to others. The value that is created is eventually, for customers, is eventually captured by people who contribute to this value creation. So in the figure, what we have here, this is the important part, value created for the company, by the company, sorry, is the value that it's capturing after paying the cost of goods sold and the value that basically customers are capturing. So all of this is a matter of how do we adjust costs, how we adjust prices so that we basically create value, if you want a broader sense for society, very narrow sense for customers, and then how do we make sure that we can achieve this. So let's go deeper into this by trying to understand different ways of measuring value creation and capture. I'm just relying on accounting measures, pretty well established, but it's kind of reinterpreting these accounting measures within strategic management. So we start with value created for customers. We don't really know. This is the willingness to pay. We can do some surveys. We can try to basically talk to them. We can play with prices to see how much demand there is for our product. Of course, all of this is in comparison to competitors' products and services. Auctions are a really good way to do this because you are basically, as you are trying to go up in the price, you basically get the person who buys it. Yes, there is going to be some value that they are going to capture. All you get is that the second person willing to buy that product, that was their limit. And then other people that had a lower limit. We can try to capture this, but in terms of accounting, we don't really have a good measure. What we know is basically that eventually some of that is going to be captured because we have a price at which we sold the product. So that's nice. That's basically some approximations. What in this case, we do know the price, and that's going to be us basically the revenues. Price plan by quantity, assuming that the products are pretty much similar. So we are going to get of all the products and services we have created, some of them, hopefully many of them, have been purchased by customers. We have the revenues of the company. This is basically what potentially we are controlling. The question now is who is getting these slices of this value that we have we are controlling. First of all, people who contribute directly to the production. We are taking the revenues, we are taking out and the cost of goods sold. People who have provided us with inputs, things that we are using in the company to basically generate that, we have to pay that. So we are ending up with value after direct contributions, gross profit. Well, let's go deeper and then let's still see how different groups are capturing, getting some of that value that the company supposedly created. Well, now we have the indirect contributions, people within the company, people and assets within the company that have contributed to this. So now we are basically discounting general administrative expenses, depreciation, amortization, other expenses, marketing, things like this that basically enables us to generate those products and services and sell them. What do we call it? Earning before interest and taxes, or operating profit. Now we also have what happened. Yes, this is nice. People who contribute directly, indirectly, people or assets within the company. There is always the financing. We are getting money. We have people that provide us with the funds to basically enable us to generate the activity. So we, of course, have to pay for them. So we are going to be paying all those interest expenses, pre-tax profit, and in before taxes. Then what is next? Of course, the government. We have to pay taxes. Why? Because government provides general, if you want, services, not only for the company, but society. We benefit from those services. We have to compensate society for the use of those services in some way. And this is basically why we end up with net profit, which is earning before taxes minus the taxes. And finally, the final, if you want, identification is, of course, we have owners, we have to pay them. Typical way of paying them is basically with, again, given the dividends, they have contributed by taking the risk and basically helping the company have the basis of capital to operate. So we basically discount that. And now what we have is all the value that after providing money to all the different people who have contributed, the company basically ends up capturing. One final thought on accounting measures is EBITDA, which is used in many cases to compare companies, although it's not part of this discussion that we're having here, but it's in many cases used to compare companies because it avoids differences in assets across companies, because you are basically adding interest, the taxes, and the depreciation amortization, so it avoids these differences, but it helps basically compare how much profitable is one company against another. But it's not part of this story. The lesson here is we can take standard accounting measures and try to reinterpret them as ways of taking value creation and then seeing who is able to who is getting the different components because they contribute to value creation. And then we have an ultimate, if you want, value capture in the company. These are accounting measures. Of course, we also have profitability ratios. It's not quite a distribution of value creation. It's more a story of how efficient companies are in using resources and capabilities, resources mostly. And here we have how efficient is a company in using sales to generate profit. And for an interpretation of this, a return on sales. Similar story, which is a very typical indicator, return on assets. I have assets, how good am I at basically using these assets to generate profit? And then something similar with equity. And then, of course, we have the final one, which is, yes, on top of that, I mean, I have all this capital invested here. So what is it going to be that how good I am at extracting value from using this capital invested? These are profitability ratios, again, standard accounting measures reinterpreted within, if you want, a strategic management approach. The other idea to remember about measurement is that, yes, we have an alternative way of looking at value creation, which is market value ratios. These apply only to publicly traded companies. They are a tiny minority in all countries. But nevertheless, because they tend to be the largest companies operating, we pay a lot of attention to them. So from here, market capitalization, what is this? It's basically value that investors think the company is going to generate in the future. How do we compute it? Share prices by number of shares. But this is not what the value that is created and captured today. It is how I think that in the future this company is going to generate a value. Price earnings ratio is basically taking this and trying to understand the value that the company might generate over what we are capturing now. And then the earnings per share ratio is what we are capturing in the year per share. All of these are interpretation of, if you want, the standard financing companies, and then the dividend yield ratio, what is distributed to owners over the value of the company. So again, important things to understand, and because it pulls everything, all the discussions we have about the strategic management down to measurement. Because at the end of the day, the idea eventually is not only to discuss sources of advantage, but try to identify them and measure them better. So with this, we now move into business models. What's the beauty or what's the advantage of a business model? It helps explain how a company succeeds. It goes beyond the standard strategic management because it puts a lot of emphasis on profitability and basically the value creation and capture. So the idea here is trying to understand how do I achieve an objective, and underlying this, the objective is how a company is going to be able to create value for customers and capture some of that value. When is a model good? Standard, if you want, also strategic ideas. It has to be aligned. What is the objective? How do I achieve this objective? Everything is consistent. Everything is basically going there, and it avoids that others are going to be able to replicate or imitate it. What are the elements? Value proposition, resources, processes, profit formula, which seem very similar to notions of customer value proposition. Why should a customer buy our product rather than competitors? Resources, assets that are tied to the company that basically I control, different from inputs that I can then use into different activities, processes, how I use those resources, the capabilities story if you want. And if everything works well, eventually I'm running not only a company that is able to provide better product services for customers, better than competitors for customers, but also internally I run this efficiently. I can basically run things very well, and eventually I generate and capture some of that value created in the form of profits. How do we understand this over time? Evolutions, that's the next story. How do we start, if you want? As an entrepreneur, what's the first thing I need to understand? Well, who are my customers? What do they want? What is the value that I can create for them? Do I have resources, access to resources that enable me to start producing those products and services that are going to match those needs? That's, if you want, the first step. The next step, okay, so I'm able to provide something. Can I do it over time? Can I repeat this over time? This is sustainable innovation. That's when I have to add the processes and start focusing on not only having a company that creates products for customers, but also running this efficiently. Can I do it effectively again, so that eventually I'm meeting not only the needs once, but over time I get customers, and then I basically get them their repeated business. And then eventually the idea is efficiency. Can I basically improve all of these things so that of all the value that I have created, I'm going to capture some of it in the form of profitability. So those are the notions that I wanted to discuss today. Business models, before we get into business models, which is a story of how a company succeeds and potentially eventually becomes profitable. It's one way of measuring things. Broader discussion of measures and trying to understand this notion of using accounting, finance within the interpretation of the strategic management, and the idea that I'm running a company, I'm going to create value for customers. There are people contributing to this value creation. I have to basically compensate them for this. And if I do things well and efficiently, I will be able to keep some of that in the form of profitability. And business models basically see as a tool for analyzing, understanding this. What is the value proposition? which resources do I have that enable me to create the processes or the products that match that need of the customers? How do I do the processes so that I can continue doing it over and over, and eventually do I do it efficiently so that I can achieve profitability? Thank you very much for listening.